Hey, how's everybody doing? Welcome back. Stock versus bonds. This can be a good one. You know why it's good? Because I wrote it almost a year ago today, right? And things I say have been changing because of the yields on bonds have been going up because prices have been going down because of the Federal Reserve. So let's take a look, right? So what's 60/40? Uh, about 20, 30, 40 years ago, an investor came up with the idea of 60/40. And basically, it's 60% stocks, 40% bonds. And if you did that correctly, you could remove or withdraw 4% of your retirement uh, nest egg. And then the next year, you can adjust for inflation and then still take out that 4% plus inflation and keep that going. And it'll survive over 30 years or until, for the most part, the long run, right? By the way, beautiful book. Grab it for free or buy it, whichever one. But go ahead and download it. It's been cooling off here in San Diego, so it feels a lot better, man. A couple weeks ago it was so hot. But anyway, so when the 60/40 rule was created, Treasury yields were high, over 10%. So they were almost like investing in the stock market, right? You didn't get any growth, but you definitely got, yield. Now, when I wrote this, the 30-year bond was 2%. Today, almost a year later, it's pushing 4%. It's like 3.5, right? So we're getting kind of to that point where it's going to be 4% on treasury bonds. So things could change a little bit, right? Because you got to think, for a dividend stock, a 4% yield is nice. Now, granted, you get growth and compounding and stuff like that, but you also take risk. Now, if I get a treasury for 4%, or how about I do both, right? So the bond doesn't trade on the stock market. The bond does trade on the bond market, but most of us aren't bond tradespeople. So we pretty much buy and hold bonds. And so we're not worried about them losing value over time. Okay, they only lose value if you sell them. If you buy it at 4%, in 30 years, it'll be worth 4% interest, right? So, you could go into bond trading, but I wouldn't recommend it unless you're privy to all that stuff. Okay, so inflation's going up, right? So at the time, inflation was getting near 5% a year ago. Now it's not transitionary; it's over 8.5%. It just came in, right? Um, so we got to think about where we're headed, right? Is inflation going to retire? Is it going to get lower? It doesn't seem like it. It seems like it's going to stay over 5, 6, 7%, right? So how do we mix that up with stocks? Stocks are down right now. It's a good time. You're getting higher yields on stocks because they're down, right? But also bond yields are up, dividend yields are up. So it's almost at this point, you kind of got to pick. We don't know what's going to happen. But I'm getting more into bonds. As soon as it reaches over 4%, I'm going to start digging in, probably almost 50-50 what I'm buying going forward. I'm not going to adjust my current portfolio, but moving forward, I think I'm going to start buying way more bonds because I can live with that 4 or 5% over a 30-year bond. Okay. So back then, bonds were trash. Now they're looking better. So as an investor, you always want to weigh your options. Okay. Do I buy a Series I bond, which is going to be probably in November, going to reset over 9%, right? And that's going to be an inflation protection, inflation hedge. You got your 30 years. Right now, the highest is a 2-year, and that's almost at 4%. It's like 3.8%. So there's some options, right? Plus, you got your stocks. But it's a double-edged sword if you don't know what you're doing. Now, let's look. Now, look at your time horizon, okay? Like, I'm 41. So if I buy a 4% bond over 30 years, yeah, it's going to be nice. Will it keep up with inflation? Probably most years. Yeah, right? Maybe for the next 3 to 5 years, inflation will be high, but then it'll probably settle back around 2%. And I'm sitting at a 4% bond. I'm sitting pretty, right? And then I'm taking those interest payments off of my bonds and reinvesting over 4%. So I'm sitting pretty. We also going to use bonds as a cash substitute, right? Because you can cash your bonds out. Now, keep in mind, Series I bonds, you can cash them, and you don't lose much except the last 3 months of interest. Great. The 30-year bond or any of those other bonds, Treasury bonds, you had to put them back on the market through Treasury Direct. And if bonds are getting slaughtered, you could lose some principal. Okay. But it is what it is. So just be careful. You can't use bonds as a cash substitute. You're probably not going to lose that much principal. It's not going to like go crazy unless you buy like a 1% bond and try to sell at a 5% time. Yeah, you're going to lose a lot of principal. But for the most part, you shouldn't lose too much principal. And you could choose which ones you want to sell, right? So you could choose ones that are actually going to make you a little money or break even. Okay. Now, so the market's in turmoil. How much should you keep in bonds? How much should you keep in stocks? Whatever you're comfortable with, right? So you can keep bonds as a way to, as an emergency fund, kind of, right? You don't want to necessarily, have to liquidate your bonds. So I wouldn't say it's your first priority as an emergency fund, but it's better than stocks, right? It's better than, at least you have a base price. Stocks, you could be all over the place. Something you could be, keeping index funds as an emergency fund or something, and then the prices just shoot down, and now you're in a tight spot. You need $4,000. You got to sell. You lose a lot of money. So bonds are close to emergency fund, right? Now, in a nutshell, 60/40, just in a vacuum, may be good, maybe bad, depending on what it is. Like, I think it's a good time to invest in 60/40. I think in the long run, it's going to pay off. I think interest rates will go down. I think the stock market will go back up. I think bond yields will go back down in the long run. So I think it's a good time to invest. I think if you're holding a 5% bond here in 5 to 8 years, then you'll be sitting pretty, right? But don't forget that there's other things you can do. Don't ever think that you need to make all your money in the stock market or the bond markets, right? Start a business, content creation, crypto is going to come back online. Rent a room, right? You're always going to hear me say these things because it's stuff I believe in, and this is the stuff where you get the real wealth, right? Renting rooms and renting a parking space. That's where you're actually creating money, and then you put it into the bond market, stock market, right? So just remember that. Don't pigeonhole yourself into 60/40 and retire only on 60/40 and your Social Security. Rent a room, grab that money, invest it into dividend paying stocks, or buy more bonds or whatever. So remember to always create money somewhere outside of work, and then you probably won't have any problems, right? So with that being said, is 60/40 still effective? To some extent, right? I think it's more effective than 100% in stocks. I think I wouldn't put my money in bond funds only, right? Because bond funds are still attached to emotions, like on the stock market. So you want to be careful about that. So 60/40 is still effective in that kind of portion of your investment portfolio, but I wouldn't want to go in retirement with only 60/40. I want 60/40. I want 3 rental properties. I want a military retirement. I want a website. I want books. I want a car. I want to be using my car as a rental business. I want to do all that stuff. And that way, that makes myself much more comfortable. All right. So with that being said, go ahead and download this book, How We Plan to Retire on Dividends 2, right? Part 4 is coming out soon, and they'll be up for free. So come back soon, right? Grab this delicious book. It's awesome. Okay. And with that being said, I'll see you on the next one. Bye, and thank you.